going live. We are live.
All right. Well, welcome to the Financial Shepherd Happy Hour. It's always a good sound.
Great
It's
sound.
Friday, Ezra. I don't know how I made it to Friday, but I'm glad that you made it here today. Since last Friday, we attempt to do these things, or I attempt to do these things by myself. And technology is a challenge for me at times. So it didn't work, but I'm glad you're here. I'm glad everything's working. And
Move into the now, Luddite.
yeah, I don't know how your week has been. My week has been up and down, much like the market, which we're going to talk about here today. But plans for the weekend?
Yeah, work.
Yeah, nice. Same. You're working Saturday and a little bit on Sunday. So why is that? Is because it's kind of the week that we had here. And for those that may be just following the show for the first time, we do very big podcasts every couple of weeks, about 45 minutes or so. But every week or almost every Friday, we try to do this happy hour, take 10, 15 minutes, just talk about what happened this week, why it happened, what can we look forward to next week after the weekend from a market perspective, and hopefully we'll give you some perspective on what history has to say about similar times, as well as how you can go about making changes in your own investments, or just ask us better questions from a viewership standpoint, which we certainly welcome. You can always text those 513-630-2664. So what a wild ride all year long. This week was kind of a microcosm of what happened.
Anytime I hear that word, I know it's going to be bad. So
Yeah.
keep it up. Let's go.
So we got the newest inflation reading that came out just a couple of days ago. Came in a little higher and hotter than economists had expected. They were looking for an inflation rate of 8.1%. Obviously, we all want to see that be lower than what economists expect. That would be great for stocks. It'd be great for just our overall sentiment as market participants. But unfortunately, that number came in just a tick above what economists had expected. It actually read at 8.2%. And core inflation hit a new 40-year high when you strip out what the Fed looks at being core inflation. Food and energy actually came in at 6.6%. Economists were expecting around 6.2. So all that leads to the next Fed meeting, which is coming at the very beginning of November. The bond market and most analysts expect the Fed to increase interest rates by another 75 basis points, which would be 4 in a row.
That's insane. I mean, that's incredible.
It is incredible, but the reason why they're doing that is if we all remember the pandemic, when the whole global economy kind of got shut down for about 18 months. I spent a lot of time talking about this with clients in our quarterly reviews, not just today, but all week long. So I'm very excited to get a little minor breather here coming into the weekend. But, you know, when we print $9 trillion, which is the most money that we've ever printed in the history of mankind so quickly, nobody really was ringing the alarm bell at the time because in a lot of ways it made sense. We're trying to make sure that there's liquidity for human beings, for corporations, so that the global financial system and the economy doesn't just completely collapse. So there was some benefit to doing that, no doubt. But what's disappointing, right? You have Fed Chair Jerome Powell. He's a very smart person. All the people surrounding him are a bunch of very smart people. And Milton Friedman, one of the most famous economists of all time, really was one of the only people that was ringing the alarm bell saying, hey, if we print this much money, just expect inflation about 18 months to 2 years later. Well, he couldn't have been even right. I mean, he was just 100% right. Unfortunately, the Federal Reserve and all of their coworkers called it transitory, meaning that, hey, we shut down the world, the economy for almost 2 years. And when you turn that switch back on, everything just doesn't get to run seamlessly. So there was all these supply and logistical issues. And I was certainly one of those that bought into that because that definitely makes a lot of sense. Ton of demand. People have been sitting at home. They got all this cash that they didn't have to give back to the government. And that demand was going to stay high. It still is very high. And that is, in fact, what is causing the 40-year high inflation because supply couldn't actually keep up. Well, the reality is none of those inflation readings were transitory at all. And Milton Friedman absolutely nailed it. I don't know a lot of people watching the show. If you are like me, you're watching CNBC, you're doing a lot of research, which I don't expect you all to be doing that. I'm sure you have other 9-to-5 jobs, kids, whatnot. But hopefully that's the reason why you're watching this show, to get these little snippets and tidbits right before the weekend and before next week actually starts. But Jeremy Siegel, he's talking about how the Fed's steering the economy. They're overcorrecting, meaning that they overdid it with printing money. Now we're overdoing it by increasing interest rates to slow all that demand down. And he believes, amongst a whole bunch of others, including Jamie Dimon, the CEO of JP Morgan Bank, came out the other day and said virtually the same thing, that in 6 to 9 months, we would kind of expect a recession sometime in 2023. I am in that camp. That does not mean we're going to go through another 2008. There is not, in fact, at least at this moment, no evidence at all of any sort of banking cracks in the system. Like, the banks are much more liquid, much more solid, not issuing all the bad loans that they did back in 2008. So normal recessions, typically run-of-the-mill recession will last around 3 or 4 months, and that typically leads into the next bull market, which typically lasts on average about 3 years relative to history. So
Gotta ride that bull, baby.
Right. And why is the market kind of gyrating up and down? Well, yesterday, when an inflation report came out, futures tanked dramatically, down about 2.5% as soon as the market opened. I took a short breather from work because I had to get my mind right and did a whole bunch of research on what history would have to say on similar times. I come back 90 minutes later, and the market was up almost 3%. It actually finished positive 3% on some of the major averages. So it was a massive reversal from where we began the day yesterday when we got that hot inflation report to where we ended the day. And then today was the exact opposite. It was down all day long. We gave away almost all of those gains
yesterday. Yeah.
which leads us to the S&P 500 being, for the week, down 1.7%. The NASDAQ was down 3.18% for this week. And the Dow Jones eked out a very small gain of positive 0.73%, which nobody's really going to start popping champagne bottles when you see those kind of numbers.
Yeah, no, I mean, it'd be nice, later on when you're sitting around watching football, you're like, oh, we had that little pop.
Maybe we should pop a champagne bottle just for the heck of it, because
Yeah.
there's been no real good reason to do so.
Well, I was about to on Thursday. That surprised me, much like you when I saw those numbers come
Yeah.
out. I just shut down all the apps, turned everything off, and then checked at the end of the day, and I was like, oh, tight. All right, here we go. And then
Yeah, you almost
here
feel
we
like you
went.
want to shotgun a beer on live TV just because of all the issues that were kind of going on here.
Yeah.
But on top of all that, so why is the Fed going to continue to increase rates? Well, a lot of that has to do with the 50-year low in unemployment. So we had an unemployment reading earlier in the week at 3.5% unemployment rate, which again is a 50-year low, which is a good thing. I don't think anybody should be
Yeah.
rooting for people to lose their jobs, even though that's in fact what Jerome Powell and his coworkers
We've been saying all year on the show too that for every one unemployed person, there's 2 jobs out there. Right?
100%.
So demand still isn't even filled.
Not even close. But we did add in September 263,000 jobs. And again, the unemployment rate at a 50-year low. So that gives all the Fed all the room in the world to make an argument that they have not done enough to bring inflation down at all. And you can expect to see a Fed interest rate increase. It's pretty much locked in at 0.75%, which again, we printed a historic amount of money. Now we're increasing rates at the fastest that we've ever done in the last 150 years. Right? It's never been done before, which is the reason why people like myself, Jeremy Siegel, the Wharton Business School professor, and a whole bunch of other folks, Jamie Dimon, I could rattle them off all night long here, are basically pounding the table to say, hey, Mr. Fed Chairman Jerome Powell, you need to pause, because they all know that there's this lag effect. When you increase rates that much, you typically don't see that showing up into things like housing, rent, food, etc. Until about 12 to 18 months after they begin to increase those interest rates. So if we continue to increase rates too fast, that's why the market is selling off so hard today, this week, pretty much all this year, is that the anticipation is the Fed will overdo it from an interest rate standpoint, which will eventually run us into a wall called a recession. Now, that doesn't necessarily mean it's 2008, but it definitely does not feel good. I think the more prudent way to go about doing this, since everybody knows that there is a lag effect with increasing rates, why don't we just pause, take a look around, get a little bit more data before we start jacking rates up or down again? Because honestly, what will likely happen if they keep going down this path, in my view, I think the bond market would agree with me as they're trying to price all this risk in to what interest rates are likely to look like over the next 3 to 6 months, is that you're eventually going to raise rates all the way up until the point in time where they can see it with their eyes, that CPI, that inflation report is coming down. The problem with that is probably going to be too late, and they're immediately going to have to start cutting rates. So is very counterintuitive just to keep raising rates up until the point where you're forced to cut it. Makes really no sense at all to me. So
Yeah.
that is unfortunate. That's what the stock market's trying to price in right now, which is why you see the S&P down more than 25%, the Nasdaq's down 35%. Small caps are really getting crushed this year, and of course, we already have seen in the last podcast that we did talking about the historically bad performance of the most recommended asset allocation of all time, that 60-40 portfolio. And if you didn't see that podcast, that is the one to definitely go back and look at, because we covered that and a whole bunch of other historical data that I think would certainly be relevant for everyone to want to know. But looking forward to next week, as we kind of wrap up here on this Friday happy hour, we will get some more data coming from manufacturing, more industrial data. We'll also get some information regarding the housing market itself. So we'll look into that. But all the research that I've been able to do as it relates to things like the CPI calculation, the biggest components of that is housing. That's about a third of the calculation there. And if you think about it, if the lag effect is 12 to 18 months, the real number that they should be reporting should kind of try to reflect that. Unfortunately, it's not, which is, again, a big reason why that CPI data came in so hot. But all the other metrics, are at least about 53% of the metrics that you would use to come up with a inflation data report, are actually falling like a rock. So that's why you see a lot of people like myself and others that were getting ready to be extremely bullish. We're basically at the most bearish place we've been from an investor sentiment standpoint, going back all the way to the great financial crisis in 2008 and 2009. And Bank of America came out and said that there's more cash sitting on hand for investors than there has been since that time. So what Mr. Buffett would say during these moments of time is we need to be greedy as a long-term investor. Long-term to me means 5+ years. So if you're trying to make money in the market, or if you need money over the next 9 months, I would raise it right now and not participate in the market. But if you don't need money for a year plus, specifically 5 years out, you're getting really close to the ability to pick up really quality companies at an exceptionally low price, which to me means a lot of value. If you can hold those for a long period of time, you'll certainly be rewarded. And that's a big part of Warren Buffett's strategy. That's how he got to the place that he is. And that's certainly something we try to emulate here for our clients. So I really appreciate the ability to give you all this information. What happened? Why? How can we handle it? What does history have to say about it? I certainly hope that is helpful. If it's not, worst case scenario, it's Friday and it's freaking 4:30. So
and the market's closed.
And the market's closed. So you don't have to worry about it for at least a couple more days.
Yeah, we got a break, 48-hour break.
Next week we'll be doing our big podcast,
episode 12.
So we're very excited about that. And I don't know if I'll need too much of notes. I think I already have everything I need. So we might just turn on the camera and the lights and just let it riff. Yeah.
Well, for any of you that are joining us after the fact, we archive all these happy hours as well as the podcasts onto our YouTube channel. So feel free to leave your questions for Joshua in the bottom in the comments. Give us a little like and a subscribe. But if not, get ready for the next episode next week and also next Friday. Feel free to tune in live when we do the recap of next week's market, hopefully with a little better of a result. And you can leave something in the chat. We're happy to answer all your questions as they come in.
Absolutely. He's Ezra. I'm Joshua Casey Garland, certified financial planning professional, owner of Shepherd Wealth Management. Wishing you all a very happy Friday. Have a great weekend, and we'll see you again next week. Take care.